Greetings everyone. My name is Kyle Nickerson and I'm a wealth manager, certified financial planner, and certified investment management analyst here with Raymond Gorell Wealth Management. Today, we'll be covering one of the most lucrative strategies within the Amazon 401k plan, the Mega Backdoor Roth. This strategy gives Amazon employees a way to turbocharge tax advantage 401k savings beyond normal IRS limits. If you or someone you know could benefit from this strategy or the other services our firm offers, feel free to contact our team for a complimentary consultation where we will review your financial situation to determine opportunities for optimization from an investment, tax, estate planning, employer benefits, and retirement strategy perspective. Without further ado, let's jump into today's topic, the Mega Backdoor Roth. So what is the Mega Roth? Well, at its core, the Mega Roth is a tax strategy embedded within the Amazon 401k plan. And by undertaking a series of transactions, employees can make contributions well beyond normal IRS limits. For instance, in 2026, employees can contribute $24,500 on either a pre-tax or Roth basis, with a catch-up contribution of $8,000 available if you'll be 50 or older by the end of the year. The Mega Roth allows certain employees the ability to add tens of thousands of additional dollars beyond this to their retirement plan annually. Now, I'd like to take a moment to refresh everyone's memory on how the pre-tax versus Roth contributions work from a tax perspective. As I previously mentioned, for 2026, employees can contribute $24,500 to the pre-tax or Roth account or some combination of the two. Pre-tax contributions, as we may know, involve making contributions before federal income taxes are paid. However, all of your contributions and your growth on these contributions will be taxed upon distribution. Now, Roth contributions, on the other hand, are made after federal income taxes are paid, and therefore, all of your future growth and your original contributions are tax-free upon distribution. The determination of whether an employee would want to make pre-tax or Roth contributions is entirely dependent upon their current tax rate versus their anticipated future tax rate. Concurrently, with your pre-tax or Roth contributions, the company will be making a 2% matching contribution, which will also be pre-tax. Now, while a 2% match is on the lower end of what we commonly see, the benefit is that it does leave a lot of room for the Mega Roth strategy. Based on the contributions discussed above, the total going into the 401k for an individual that's maximizing the pre-tax contributions and making $300,000 per year is $30,500. And that's from a combination of the employee's contribution as well as Amazon's match. This $30,500 total is well below the IRS maximum limitation for all sources of contributions, which is $72,000 for those age 50 and below, and $80,000 for those over. So where can this $41,500 difference between the IRS limit and the other maximum contributions go? You guessed it, the after-tax account. Let's discuss the tax features of the after-tax account because they're a bit of a blend of the pre-tax and the Roth accounts. After-tax contributions, as the name implies, are made after federal income taxes have been paid from the funds. However, growth that occurs while inside of the after-tax account will be taxed as ordinary income upon distribution. So you might ask yourself, Why would I contribute to an account with no current tax bill reduction and all of my growth will eventually be taxed as ordinary income? This is because we don't leave the funds in the after-tax account to grow indefinitely. The Amazon 401k plan allows participants to convert these after-tax funds to Roth. And the best part? If funds are converted to Roth before any growth occurs, the conversion is entirely tax-free. Here's how it works. Once the normal pre-tax or Roth limit for contributions is reached, the employee may defer additional funds into a third repository within the plan, the after-tax account. Subsequently, these additional funds are converted into what's called the Roth account, where you will enjoy tax-free growth until they're distributed in your retirement years. At this point, we hope it's becoming clear that this strategy can be an absolute tax home run for retirement savers. It's also important to note that most 401k participants outside of Amazon cannot use this strategy. While some large companies do have this capability, if you look at all eligible 401k plans in the US today, we estimate that only about 3 in 10 offer the Mega Roth strategy. To better illustrate the tax benefits of this strategy, we'll compare an individual who fully utilizes the Mega Roth strategy over their career versus diverting the same after-tax funds into a taxable brokerage account. Using the same numbers from the previous example, let's say this employee contributes $41,500 per year for 20 years into a brokerage account. Assuming an 8% growth rate, these contributions will grow to be $1.89 million over the 20-year period. This means that within the taxable brokerage account, there will have been $830,000 of contributions and roughly $1.06 million of growth. Assuming a 15% long-term capital gains tax rate, this will result in over $159,000 of taxes paid when the assets are sold. If instead this employee utilized the Mega Roth strategy over the same 20-year time frame, all of the dollars could be distributed in a tax-free manner, resulting in well over $100,000 of tax savings. Now, before we wrap up our conversation today, I'd like to draw your attention to a few important considerations surrounding the Mega Roth. If you have a pre-existing after-tax balance within your 401k or growth on your recent contributions, you should be aware of the Pro Rata Rule. The Pro Rata Rule states that if an after-tax account contains a mixture of contributions as well as taxable earnings on those contributions, any conversion or distribution from that account will be partially taxable depending on the ratio of contributions and earnings. These transactions require supervision for successful completion, and the numbers are different for everyone. So we absolutely recommend that you discuss this effect of any balance that you may have within your after-tax account with a tax expert, such as our in-house CPAs, who can help you understand the tax implications of any future conversions. Thanks again for spending time with us today to learn about the Mega Roth strategy. At Raymond Grail Wealth Management, we have over $1 billion in assets under management, and as a firm, we strive to serve as an effective one-stop shop for comprehensive retirement planning. Our team of certified financial planner and CPA professionals specialize in helping clients take advantage of advanced financial strategies to materially enhance their ability to enjoy life before and after retirement. We invite you to schedule a complimentary consultation with our team by giving us a call, sending us an email, or visiting our website today.